So, Brad, this is a really good one, I think, for you to answer. You obviously work with a lot of clients, both young and older. But I think the majority of the time it always starts with the question, why should I or we invest?
And mate, it's actually not as silly as a question as people might think it would be, because why should you invest? Well, ideally, people are always searching for that work-life balance, and not everyone wants to work till they're 70 at the way retirement's going. They're sort of looking for that, as I said, work-life balance, and that passive income is probably a key term that I hear a lot. So obviously, if you're sitting in cash and inflation's going up, you're not really going to keep up with those times. So investing will support you to do that. And as the great Shaquille O'Neal said once upon a time, it's not about how much money you make, it's are you smart enough to keep it. And that's what investing will support you to do for the longevity. And
inflation is a term that's being thrown around quite a lot at the moment because of everything that's going on in the macro economy.
Yeah.
So just unpack, you said if you just have cash sitting in the bank, inflation's likely to eat away at that.
Yep.
How does that actually work?
Oh, mate, I think everyone's got a different theory into it all together, but I like to break it down to a simplified approach for the punters, where back in the day you used to be able to buy a schooner for $1, then $5, then it got up to $7. Whereas,
mate, some pubs in Sydney, 15 for a schooner.
That's called highway robbery, but that's okay. That's a different type of conversation. But ideally, that's what inflation is. As people get comfortable with buying and purchasing with that amount, it keeps moving up to keep with the times. But if you're sitting in cash, you're not really keeping up with it at all. You're sitting at a neutral or $0 or 0% baseline.
So essentially, it means that the dollar that you have right now over time is going to have less buying power.
Yeah, correct.
And by investing, naturally, what we're trying to do is not just keep up with inflation, it's to outpace inflation. So our money is not just staying the same, but it's obviously growing.
Yes, spot on.
Mate, there we go. You think I've done this before, huh? So we're going to run through now what it looks like to build an investment portfolio. And naturally, my forte is property, and that's how I've built out my own personal portfolio. Brad, your forte is equities and superannuation and those types of assets. So we're going to unpack what it looks like to build a holistic investment portfolio where you can potentially incorporate all of those different investment vehicles.
Yeah, very.
Mate, run us through. So like I said, I'm in property. You're in all the other asset classes. What would you say are the most common asset classes for the majority of the clients that you work with?
Well, mate, so just to go back a step further, you got your 5 main ones, which starts with cash, being with bank accounts, fixed interest, term deposits as an example, Australian shares, international shares, and then property, which is quite a broad topic for most people. But everyone's heard of all 5, but they don't really necessarily break them down. Most common, they start in cash, and the journey tends to be going through each of those 5, I guess, to end up with property. Don't really come across many that say, I don't want to buy a property at some stage in my life. So,
And do you reckon most people want to buy a property as an investment vehicle, or are most people looking to invest to then get them into a property which they classify as their owner occupier property?
Well, mate, it's actually funny. It's a bit of 50-50 to be completely honest. Some people do see property as that asset accumulation, whereas some people see it as a home and safety and security. So both play a part, but I wouldn't say one outliers for the other.
Okay. And when we're talking, I guess, investment strategies, obviously what we do is we build out clients' property portfolio strategies. So the majority of the clients that work with us are very pro-property, not saying they're not in other investment classes, but they're very bullish on the property market. They understand leverage and being able to use a significant amount of someone else's money, usually the banks, to be able to get into an asset class with a very small amount of their own liquid cash. And as they continue to invest from property to property, they're continuing to use not even their own money, but the bank's money through obviously releasing equity and purchasing property. And we build out portfolios for properties, but when you're building out investment strategies, this is obviously a webinar which is targeted at the younger demographic. When you're meeting with someone who is younger, let's say mid-20s to late 20s, early 30s, and they said, Brad, I've got some cash in the bank and my goal is to finish working by 45. What does that process look like?
Well, mate, it's a bit of an education piece to start off with, because like you said, if someone starts with a bit of money in the bank, they want to know how they can get from that money to the property, and it's a big jump. So usually there's a lot of, resources available online that they'll go Google, whether it be Acorns or other investment platforms like the banks that offer to people to start dabbling with ETFs, managed funds and direct shares. But for as long as whilst they're working, they're starting to accumulate that wealth and they start to teach themselves along the way. That's where I provide, a service to them to understand it and to invest the money to work up to that 80-20 LVR to buy the property. And then once they understand that principle, then they look at the equity, and then they then go back and engage someone like yourself, because if they start talking to me about property, I can't necessarily help them. I can educate them around the structure. I suggest talking to someone in their profession, like Henderson Advocacy, an old guy like who works there.
Old bloke.
To get further support and advice around that, because I'm not pro or con one or the other, but if they can have a good balance across both, they're sort of coming from all angles.
Yeah, so it sounds like the major goal for the majority of younger people is to build up enough cash or enough money invested in equities or shares to then use that money to, I guess, transfer over into using it as a deposit potentially for property.
Yeah, 100%. You've hit the nail on the head there.
And then how about superannuation? You know, are many people thinking about superannuation? Because naturally that's, you know, quite a large investment vehicle, which a lot of people probably don't realise that they have until later in their life, because it accumulates slowly through contributions. Is that an investment vehicle that's on a lot of people's minds?
Mate, it is, but like you said, it's one of those ones that people don't think of because it's not until later in life. But the government's been great in Australia with ways of supporting that, with first home super saver schemes where people can actually contribute to the super fund to build wealth inside the super fund and then withdraw it along with the associated earnings. But with that, it also reduces their taxable rate at the same time. So whilst they're making their money work for them, they're also reducing the tax they have to pay, which works as well. So super is great in that regard. It's one of the biggest assets they'll have outside the family home when they do get to retire. So just sort of making sure that's working for you for, you know, your working life, and taking the tax concessions or benefits that come along with it helps as well.
And super is an asset class which you can't access to a certain age.
Yeah, correct. They have different rules you have to meet to release post certain age groups, but they do make it tricky. But when you get good advice,
what is the age for young punters like us?
Now, there's preservation age, it's around 55, but then over 60, it's pretty much a free for all.
Sure. So someone who's say 25 to 30 years old now, you know, it may seem like a long way away, but small contributions over a very long period of time, with compounding doing its thing, makes a significant difference when you get to that age.
I was going to say those key two words, compounding interest, works wonders, provided it's done in the right way. If it's just sitting in cash within your super fund, well, you can't push the rewind button and start again. You're pretty much up shit creek. So,
well put. Building out an investment portfolio, it's obviously very good to invest, to put your money into these different asset classes like we're talking about, but you need to have the money to be able to put into those asset classes, and you can't have money unless you're disciplined around your discretionary spending. So when you're building out a strategy, is budgeting a big part of what comes into the overarching investment strategy from get people from A to B?
Mate, yeah, it is. And budgeting's a hard one, because changing people's beliefs or their spending habits, you can't physically be there and be tapping their card or prevent someone from tapping it. I find automation's the best way around discipline. If you set up direct debits into investment accounts before they can actually get to it, that helps. But one thing that technology's been great for us is OSCO, which is all well and good, but then, you know, if you're out and let's say you've had one too many schooners, you might transfer yourself some money that you probably should have saved, which isn't ideal. So discipline and discretion, discipline around how you spend your money, not discretionarily spend it, is probably a big harder thing to save for those savings to get to your first property or where to start.
And do you have like a percentage of gross pay that works across the board, where you say to clients, if you can save X amount of money and invest that into these different asset classes, that's going to be a strong foundation to work from, or is it different for everyone?
Mate, again, it's different to everyone. I mean, outside your big three of housing, food, and transport, with how people spend their money, I'm not there to tell them what to do. I want to be there to work with them. So, but as much for how hard they are to work towards that goal and to be committed to it, I'll work with them and meet them halfway to make sure they achieve it.
So essentially, by the sounds of it, if someone's a very aggressive investor and wants to, have ambitious goals, naturally their investing and spending habits have to align with that, right? If you've got a goal to retire by 45, but you spend like there's no tomorrow, probably not aligning.
Correct. Or it's like people are like, oh, I can't afford to save any money, but they go punch about 1,000 durries a day or buy a pack of cigarettes. You go, well, that answers that thing, mate. So it's not that you can't. It's everyone's got choices. I'm not saying one's right, wrong, or good or bad. It's just can't complain about what you don't have if you're choosing to spend your money elsewhere.
Exactly, and that is a good legway or segue, I should say, onto the starting point, right? Because I think a lot of people, especially around our generation, don't start to think about investing or their future or retirement until they get into their maybe late 30s, early 40s, and then it starts to become a reality because 20 years has just swung by from when they started working.
Yeah, correct.
What do you see with all the clients that you work with, the most successful, investors? Do they usually start when they are young? Do they start when they're older?
To be honest, I found it starts well before that, when they're young, when they're kids. I find when it's taught down from the parents and they see parents disciplined with their money or good budgeting or something along those lines, they've often been the ones that have done the best. I love seeing the stories of the ones that have actually come from nothing, and they've just worked really hard. But yeah, to be honest, it usually starts from they're being taught by their parents, and that's carried through for the rest of them. And
there's no secret, and most people would know, I would say, that obviously the younger you start, probably the less aggressive you have to invest, and the longer compounding is able to do its thing. And we see the same in property. Like you always look back at people who are maybe in their 60s or their 70s, and they bought property when they were 18 years old, and they may have only purchased 2 or 3 properties over their whole lifetime and never sold those properties, paid down the debt to zero over 20 odd years of each asset. And they get to retirement age, or the age in which they have the choice to work or not, and they've literally got $5 or $10 million sometimes from just buying. A lot of the time they buy an owner-occupier property, of which they then turn into an investment property, and then the next one they also then turn into an investment property because by that time they've paid down the debt quite significantly on number one, and they're not reinventing the wheel. They're not investing in all of these crazy schemes or new asset classes like crypto and all the rest of it. They've just done something consistently over a long period of time. And when they get to a certain age, I even look at my parents and the wealth that they've created by simply just buying properties, often renovating them to get them how they like it, and then moving on to the next one is pretty remarkable. But I think a lot of us struggle to foresee into the future of when we're actually going to need.
Correct. And it sounds like what you just spoke on is that very much the sit and hold theory, which you could probably attest to and speak to, is that point there, long term versus short term. Would you say that is the main way to go about it to live out that example you just used? Or?
Yeah, well, I think there's probably some very successful investors who, are good at short-term investing, and those type of people or type of investors usually have information that the average punter doesn't have, right? Because to be able to make successful short-term investments, you usually have to have a significant amount of information that other people don't, or you need to be lucky. A lot of people probably made a significant amount of money in crypto recently over the last 3 or 4 years, but would you put that down to luck or would you put that down to skill? I don't know. Long-term investing is what I'm a big advocate of in property, and when you invest over the long term, you don't really need to worry about what's happening in the short-term micro. So at the moment in the property sphere, obviously interest rates are a big topic. They've increased quite significantly. Every paper you read from Monday to Sunday is something to do with property prices decreasing and blah, 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 blah. But none of that actually matters if you're buying a property and looking at holding it for 25 years, because you're bound to, over that period of time, regardless of when you buy the property, to have really, really good times like we saw, pre-21 to 2018 to 2021. And you're probably going to have some bad times. If you just look at the last 22 years since the year 2000, we had a dot-com bubble, we had a global recession or a global financial crisis. And at that point in time, when we're zoomed in on the microscope living our daily lives, it can seem grim. But when you then zoom out and go, well, look at what's happened just in property from 2000 to 2022, I don't think one person in Australia would say that I was unhappy to buy any property really in the year 2000 near a major capital city. So I'm a big advocate of long term, because you don't have to be as smart, you don't have to be as lucky, you just have to make a few really, really good decisions. And Warren Buffett says this really, really well. You only need to have, if you refer it back to a game of baseball, 1 or 2 really good bats, and you can change the game. And that's the same. You don't have to hit the ball every time an opportunity comes to you, and that's the great thing about investing over the long term.
Just while you're changing the slides, when you say long term, in your mind, is there like a long term time frame that you sort of stick to, or do you just sort of guess?
Well, ideally, you never want to sell, or I think I never want to sell until it gets to the point in time in which I'm now consolidating and looking at, changing my investment strategy, which we're on now, from an acquisition phase, which is
What a
still
segue.
accumulating, into now going, okay, well, now it's time for me to look at maybe starting to liquidate some assets and moving it into something that's a little bit more cash flow producing, so I can have that, work-life balance like we spoke about.
Yep.
But if you're an 18 to 25-year-old and you've come out of uni or you finished your apprenticeship or whatever it is, and you're starting to invest, you've got 20 to 50 years ahead of you. You don't have to do a great deal over that time frame. You just have to do it a very small amount consistently,
Yep.
and you'll literally change your life. So we talk about large numbers a lot of the times with our clients, and it can be sometimes in the tens of millions. But the reality is, to live an incredible life, you don't need that much money by the time you get to a certain age if you've got no debt. So if you have a passive income of $150,000 or $200,000 a year, which if you invest over the long term isn't very hard to achieve, you can live a pretty good life when you don't have debt. So I think it's all relative to the goals in which that person's looking to achieve, right?
I think it's funny when you say that, because when I have clients and they're about to retire, okay, how much do you need to retire? And they say, I don't know, how much do you think? And I said, they said, they often come back with, I think I need about $2,000 a week. And the question I respond to them is, if you have no outgoings, no debt, are you really going to spend $104,000 a year? And they go, oh, shit, no. I'm like, so do you want to answer the question again? And like you said, so once you pay that debt down, you can have that work-life balance, but it's just changing, I guess, your mindset.
Exactly, because if you think of most people's incomes, up until the point in which they retire, 70% of it thereabouts would go to bills, mortgages, kids usually, and all the rest of it. And they've lived on that very small 30% portion their whole life.
Yep.
Which means the reality, for the vast majority of people, you could have half the amount of income, or maybe even a quarter of the amount of the income, but all of it be discretionary in retirement, than actually needing 100% of what you've earned your whole life. So, mate, this is a good segue onto where to start. So if people are now looking at going, okay, well, I want to start investing, I've got a long-term approach, which is obviously what we advocate for. I don't want to make short-term reactive decisions. Where would you advise the majority of people start, regardless if they're 25 or they're 45 and thinking they need to do something?
Yeah, look, I don't think there's anywhere right or wrong. I just think just start. You just need to start, and I think once you start, you'll find what you enjoy. For me, like you said, I found liquidity was what I enjoyed. So direct equity, shares, ETFs, that sort of was my preference. And then some people love property, but either one, whatever path you go down, or even if it is businesses, it's do your research what it is you're passionate about, why you want to do it, what it is that you're getting into, because a confused mind doesn't buy. If you do, you get that buyer's remorse and you get questions. So where to start? Just start. You won't know, you're not going to get it right first go, and if you do, good luck, but at some point in life, whether it be failing or whatever, investing or just generally in life, you're going to get it wrong. But it's moving forward.
And do you think, or do you see the majority of people doing it by themselves first? They get a CommSec account and they go, let's start buying some businesses and trading, and then they often come and see people like you, or? Yeah,
they do actually, and it's good to see, because I find those clients, they're really engaged, because they've sort of got on a scale of 1 to 10, they might have a 1 to 5, 1 to 3 knowledge base. So you can have an engaging conversation with them, which is really good. And look, I've got one friend who actually jagged it. He bought a penny stock and that bought his first house for him. It just took off. I think they got bought out by Samsung. So you can get your good luck stories. So as I said before, the material online is so accessible, whether it be CommSec or Westpac or Acorns, where it saves your senses from your online shopping. There's a lot out there for people to start, and you can't go from the shit house to the penthouse overnight. You have to go through each room, as they say.
I like that, the shit house to the penthouse. And then how would you then look at going, okay, someone started, they've either had enough liquid to get a deposit for a property, or they've got a small amount of liquid to start with, or cash to start with, and they start investing in different equities and different shares. How do you look at someone's portfolio and then start going, okay, well, you're pretty heavy in property, or you're pretty heavy in shares. How about we start looking at, maybe putting some of this cash into a different asset class? How do you look at asset allocation inside of a portfolio?
I usually start with personal preference, because like I said, I'm there to work with them, so I'm not there to tell them what to do, but you can we've been through one economic downturn with COVID, I hate to use as an example point, but then we've had the property prices come down a bit. So it's great for a lot of today's punters and investors to actually give 2 real life examples, knowing that you don't want to be 100% in one, because if all your money was there, rising interest rates as well and property prices coming down, people start to feel the pinch. So had they been a bit diversified, I'm not going to say you'd completely come out neutral, but ideally you want them to operate negatively. So if one goes good, the other one, if it's going bad, they sort of compensate each other. But
Sure.
it's sort of personal preference too.
And you see, some of the, people like Ray Dalio, for example, the way that he looks at portfolios and being able to hedge against risk, by having portfolio structured. The reality is, for the majority of people, they don't need to get super sophisticated, right? Like
No,
it's
not at all.
about starting a lot of the time, keeping it very simple, and like we said, doing it over a long period of time. And a lot of the time, that gets rid of those road bumps that you may see in the short term.
Absolutely, mate. Simple and easy, I think, is key. You can be the smartest bloke in the room and talk all the jargon in the world, but if no one understands what you're saying, you're not going to make much headway. So I agree with what you're saying there. Simple and easy is key.
And then, what are your thoughts on diversification versus specialisation? Because obviously, in the field that I'm in with property, a lot of our clients are very pro-property. They want to only have a portfolio. They want to continue to leverage and build up, a significant property portfolio. And that's obviously a specialisation, right? If you're an expert in property and you understand the markets in which you invest in like the back of your hand, naturally you can make a significant amount of money. And then there's the other side of the coin, which is, diversification. And, how do you see that?
Well, yeah, I agree with you there. Like, as I said before, I don't agree with having all your eggs in one basket. If I had someone come over and they were heavily in property, that's great, because when you invest, you want to look for 3 main reasons: income, growth, and tax. You're going to get some better tax benefits from property, for example, than you would in direct equities, and vice versa. So I think it is important to diversify, but knowing where and why, what your purpose is, and just knowing that if you can keep it sort of balanced, that's ideally what you want to look for.
And when do you recommend, or when do you advise your clients usually to start diversifying? Like, if someone comes to you with hundreds of thousands of dollars in equities, for example, would you say to that person, where you have got a lot of equities but you haven't got any other assets, let's look at something else? Or is it at a much smaller level?
But yeah, it's pretty much that example exactly. High income earners, for example, if they got a lot of money, we can have an investment portfolio. That's all well and good. The growth goes up, but they don't pay any tax until they realise it if they sold out. But the income's added to their assessable income, so that's not ideal. So they might want to go look at taking some of that money and go buying that investment property. Seek someone like yourself to go, okay, I need to reduce tax. Growth's great because, like I said, don't pay tax till later on. But if I can look at ways to, get tax deductions through the property, that works in their favour. So that's there. And
then the I guess most important thing is, like we said at the start, it's starting with your why.
Yeah.
And if you're clear on your why, you've got a good strategy, you invest towards a goal. How do you then know it's time to get out? You've hit your goal. Obviously, there's a lot of people who get to the end of their lives, or the end of their working lives, I should say. When is the time that you go, okay, well, I've done what I needed to do. I've hit my goal. I can now get out of work. What does that then look like? Do portfolios change when you come to that stage of life?
Yeah, they do. But I think that all goes back to the start. You got to know what your purpose is and what your why, and knowing when to get out, because greed will kill you. It absolutely will. You can keep chasing that extra dollar, but there's nothing wrong with leaving a little bit on the table. And so there'll be a shift. Let's say from you're 25 right up until you're starting to think about retirement, 55 to 60. You're obviously accumulating that wealth. You've got the time frame to take the risk. But when you're starting to get to those closer years and you don't have another 55 years ahead of you to try and accumulate it, you'll pull it back rather than trying to accumulate the growth, and you'll start to look for more of an income focus, depending on whether you're super pension phase investment or whatever. So when to get out, I think it's absolutely key. Knowing what your exit strategies are always important, but then sometimes knowing when to shift as well.
Which then goes on to the discipline, right? Crypto is the one we've got there, and that was obviously, it's been the hot topic over the last 4 or 5 years, and some people have done exceptionally well out of it, and I think a majority of those people probably have done so by luck.
Yep.
Have you had a lot of clients come to you and ask you about these alternative asset classes?
Oh, mate, it was one of the definitely hot topics, and every second person wanted to ask about it. And look, if they want to have a dabble, I support them, but that's outside of my scope of advice. But it's again one of those things. If you don't understand, if you're not educated around it, you don't do the research. I wouldn't buy it. I don't buy it. Usually, a lot of stories I hear is people get excited and they start going down the rabbit hole, and next thing you know, they've lost it all. So, discipline's key. If you're going to have a dabble, so be it. But if you're going to, put 5 in and you want to pull out 10, get out. As I said, don't get greedy. Be disciplined. Educate yourself around it.
And for people who want to have, say, a dabble, let's hypothetically say they've got a portfolio, that's 50% in equities and 50% in property. As a percentage, what would you allocate for things that are, maybe a little bit higher risk, which you would classify as a dabble? Is there a percentage or?
Not really. You sort of identify what they can afford and what they're comfortable with. And if someone goes, I don't know, go, okay, how would you feel if you lost 10 grand? You see the blood come out of the face and they look like a ghost. Okay, so you're not happy with that. Would you, $100, $1,000? $100 means a difference to everyone. So if someone's only comfortable to lose $1,000 and they're aware of what they're going in for and they know what's going to happen, well, then all you can do is really support them, good, bad, or indifferent.
Yeah, I had a few friends that lost a bit of money in crypto.
I had one recently, actually.
And then the last two, obviously, I think every investor wants something different, right? People at different stages of their journey want to grow their capital base. Yep. As you just spoke about, as you move closer to retirement, you usually want to improve your cash flow position because that's what you want to start living off.
Yep.
And naturally, the way that you invest and what you invest in then has implications on what you touched on before, which is the overarching, tax implications and tax strategies. Because I don't know too many people who just love paying tax.
No, I don't know anyone that does either.
So what are some of the tax strategies that an everyday person can try and take advantage of? You mentioned one before about potentially salary sacrificing into your superannuation.
Yeah, so the three main ones to reduce your tax is you borrow money to invest, whether it be margin loan, so good debt, investment property, again borrowing money from the bank. That's good. That's one way you can claim tax deduction. Contributing to super up to 27.5 concessionally will reduce your taxable income. And then the last one is biggest grudge purchase is the old income protection insurance, keyword. So you claim that premium as a tax deduction, which it's better to protect your income rather than paying tax, I think so.
Exactly right. So with the superannuation, you said 27.5%,
yep.
Which essentially means 27,500.
Jeez, you're feeling generous. 27.5%.
If you earn 100,000, that's 27.5%.
So you're good at maths.
$27,500 per year is the maximum someone can
concessionally, before tax.
Yeah.
So for example, say someone was on 100 grand, they put 27.5 in. It would reduce it down to 72.5.
Right, and then you only pay tax on
the 72.5. Yeah.
Quick maths, mate. There you go.
Yeah, I know. So on average, someone who's on 100 grand per year pays about 25 grand a year in tax. So obviously, if you can reduce that, get into a lower tax threshold, it's much better than paying more than you should.
Yeah, and you're growing your wealth by putting more money into superannuation.
Yeah, correct.
All right, mate. We're next slide here. We've come to a bit of a standstill, mate. Long-term wealth creation, which is what we've been talking about, and I guess the three main points on this is what is the overarching time frame, right? Long-term for someone who's starting to invest at 18 looks a little bit different for someone who's starting to invest at 45, right?
Absolutely. Yep.
Time in the market, which is what long-term essentially stands for, right? The longer that you're in the marketplace, the less that you have to worry about short-term market fluctuations. Or there's also those people out there that think they can try and time the market, right?
Yeah.
A lot of those fortune tellers at the moment in the marketplace with the property market. It's going to fall by X or Y percent, and you shouldn't buy until this month or that month. But the reality is, who really knows?
Yep.
And then consistency and the impact that makes on long-term wealth creation, right? Because if you just put one chunk of money in when you're 18 years old and do nothing for the next 30 years, it's probably not going to have as big of an impact on doing small amounts of investing over a very long period of time. So what do you see as an average or the perfect time frame that most people should look at the investing lens through if they're starting, at a 25 to 30-year-old person?
Yeah, well, I think you can break it down in a few different categories. If you include super in that, you've got 40 years, so just know that's going to keep ticking along over time. Time frame is important because if your time frame is 3 to 5 and you have a good year, the first one, the next one it goes pear-shaped, I would say don't lose your shit, because you can always your time frame's 3 to 5 and you're getting upset about something that's happened that's not in relevance to the longer trajectory of your goal. So time frame is important, but knowing what it is. Like I had a client the other day who was gifted 150,000 and he wanted to go invest it to buy a property, which was almost not the greatest idea, because if he did, he would just have to pay tax on the capital gains to buy the property. So knowing your time frame is important, and knowing that you will get fluctuations, but if you stick to your plan, it should smooth out in the end.
And the time frame that you're working with, would you say, does that have an impact on what the investment strategy looks like?
Yeah, absolutely. Yeah, absolutely. I mean, if you're, as I said, use that one as an example. The guy wanted to buy a house in the next 12 months. We're not going to put 150 grand in the market, because if interest rates go up tenfold and all of a sudden it all drops, then I look like a real dickhead. So I can't be doing that. So you got to use your expertise as well. So it's obviously in that situation, you'd want to keep it really conservative. But if he said, I don't want to use that money until 5 years, well then, okay, we can go expose it and ride out some volatility, but ideally trying to get a good return over that period.
That makes sense. And then what about time in the market versus timing the market? How many clients do you speak with, or prospective clients that you speak with, that are trying to get into the next hot thing and get in and get out and make a fortune and retire in 3 or 4 years, as opposed to people who come to you and say, I know this is going to take 30 years and I'm happy with that?
Man, my best friend is the bloke that wants a quick rich get quick scheme, and it's so annoying because he just thinks he can put it in and pull it out, so it doesn't work. But part of the job is also educating people, knowing that, like you said, if you had the crystal ball and the lens to know what was going to, go down and when it was going to go up, everyone would be wealthy. So it is a common conversation you have, but you've got to manage people's expectation, and it sort of ties in with that time frame conversation as well. So I agree with it. I've heard it ever since I've been doing this for 11 years now, and that's always been a key saying. It's not time in the market. Oh, sorry, it is time in the market.
It's not time in the market, it's timing the market. That's what you say to your clients, to bet the house. And the consistency, like, do you see that a lot of people are consistent with their investing?
Yeah, they are, man. Consistency is key. Like you said, that example, you can't just put 30 grand in and hope that it's going to grow overnight. It takes hard work, it takes discipline, it takes a regular savings plan, because it's not going to grow on its own. If you don't commit to it and you don't work towards it, it puts a lot of stress and strain on trying to grow that to where it has to be. So if you know it's working for as hard as, if it's working as hard for you behind the scenes whilst you're out on the front line doing your job, everyone's getting to go on.
And what about when times aren't so great, right? Because it's easy to be consistent in everything in life when it's easy, right? But especially when you're talking money, right now it's probably not an easy time to be consistently investing, because the macro market, whether it's property or equities globally, is not that great, right?
Yeah.
We're in a rising interest rate environment. So how challenging do most people find it, and how do you advise people to say that, you've had a really strong couple of, or last 3 or 4 years, but you still need to be consistent during these, not so great times?
Mate, this probably goes back to the keyword of diversification. So if you can invest now, and what you probably only see is the All Ords or the Dow Jones in America and Australia, that's not the whole picture. For example, you can invest in funds that might cover the top 50, but then you've got ones from the top 50 to 300. So when that top 50s sort of realise their value, you've got the other ones behind it coming through, like a JB Hi-Fi or a Domino's Pizza, which will supersede that growth to when those other ones have reached their
Was that
cap.
a hot tip, mate? Was that a hot tip? Or?
So that consistency is important, unless you can see behind the curtain, which none of us can. Stick to your game plan and just ride it out, because if you've got the right people on your side to work with you, they should be doing their job and they'll manage it accordingly.
Mate, very, very important. And I guess that goes back to not trying to time the market, right? Because if you're trying to time the market, that's when you are trying to say, no, well, I'm not going to invest right now, but I'll invest in 6 or 12 months' time, because it might be a better marketplace.
How do you find that? Because I've had clients ask me, I'm thinking about buying, but I'm just waiting. I'm just waiting. But that day's probably might not ever come for them. Do you find you have to educate people around that as well? Because I hear people say a lot, I'm just waiting until next year, I'm waiting to this, I'm waiting to that. How do you time the market, or just say to them, get in, be consistent? What's your approach?
It's exactly the same thing. Yeah. It's obviously harder to be consistent with property because there's a lot of variables that come into it, right? Like serviceability, the incomes at certain points in time, actually being able to get the money from the banks. So my recommendation to all clients, and what I do personally, is when you've got the serviceability, so when the banks are actually willing to lend you the money, and when you've got the financial capacity to be able to hold the property for the medium to long term, because the last thing you want to do is bet the house on something, have no cash, and then something, not go to plan,
Yep.
then that's when you should buy. So everyone wants to buy and everyone wants to invest in anything when everyone's making money, right? Because it's exciting, you just feel like you'll never lose, and everyone's out there making something, and you get FOMO. But the reality is that's probably the worst time to invest, because you're paying premium prices, you're competing with the masses, and you've got really no advantage to anyone else. Sure, you may get some quick wins. You could have bought a property in 2020, and by the end of 2020 or the start of 2021, you could have gone up by 20 or 30%, right? But again, that's trying to time the market. So right now, we're still buying property just like we would have last year and the year before.
Yep.
And the educated people and the people who understand that you don't get rich overnight are the people who are actually taking advantage of this now, because you don't have as much competition. You have vendors that are much more willing to negotiate on price, which means you can negotiate harder. You've got a better selection of stock, because when a marketplace is super competitive, you get in there and you make irrational decisions because you feel like you're never going to be able to get something, and you don't want to pay a premium for that property because it wasn't worth it. So you try and find something cheap. So you usually buy an inferior asset.
Yep.
So, in marketplaces like this, and we saw it only a few years ago when COVID first hit, only takes a quick Google search to see what the headlines were then. It was the marketplace is going to fall, and, property prices are going to, crash by X%. People are going to lose their businesses, blah, 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 blah. And as we know, that didn't happen. And it's the same right now. We might have a marketplace like this for 12, 24, 36 months, but if you've got a 15-year view, if you're in the marketplace from right now, as soon as it kicks again, and it will, that means you feel 100% of that next upswing because you're already in the marketplace. But if you're trying to chase the market, so as soon as the Sunday Telegraph says now's a great time to buy, it's already too late, because you've missed the first 15 to 20% of the market upswing, and it's not reported in the data that you miss it. It's all of a sudden the property goes from being $800,000 for the last 12, 24 months, and then they get a few really competitive auction weekends in a row, and that $800,000 property goes from 800 to 920, that one down the road just sold for 920, and all of a sudden then you're chasing. Where if you're in the market from the get-go and you paid 800, you feel that first $120,000 worth of growth straight away. And that's the most important thing. And for people who were in the marketplace, who just experienced the full upswing of the last market that we had over the last 2 years, it's a testament to that. Like, your property could have doubled almost in 2 years, but if you got in 12 months into that growth phase, then you got half of that growth. So that's what I think is super important. And it's probably the same with equities and companies, right? If you get in when it's already had its huge uptake, then you're not going to feel 100% of that growth.
Correct.
And mate, this is probably the most important one, which is what not to do when you're investing, right? Because it's easy to have a time frame. It's easy to have a strategy when you've got the right people around you. It's easy to be consistent, but you need to make sure that you're not making silly decisions which can actually unravel a lot of that hard work in which you you obviously work so hard to create. So we've outlined here the three biggest learnings on what not to do when you invest, and the first one is bad debt versus good debt. So do you want to run through what that actually means and what some of the best examples are?
I can testament to this. I remember when I was 17, 18, as soon as I could drive. Worst thing, number one, and I see it even today, is bad debt, car loans. I remember all I wanted to do was just get a car, probably the most expensive car that my ego could afford, and drive that. And man, that crippled me for years.
What were you in back in the day?
I had a 94 Liberty, which cut out. It was an automatic and used to stall. And then I had another Subaru, and I just had a loan for that, $9,000. And yeah, mate, I just started, again, I had no education around money. I started to teach myself, but yeah, I had a loan for that, and I could have paid it out, and then I doubled down on that, and I bought a BMW again, just because I thought it would be nice and cool, and made every excuse under the sun to justify buying it, but it was the stupidest thing I ever did. I wish I just got a car that I was comfortable with and got me from A to B, and moved with the times rather than jump further ahead than I was ready.
So bad debt is essentially debt that is attached to depreciating assets or things that are going to cost you money as opposed to make you money. Is that how you describe it?
Yeah, correct.
And then good debt is usually debt which is used to invest or used to buy things that are actually going to make you money or increase your wealth.
Correct. Yeah. So two examples being a margin loan, so borrow money to invest, to buy, set up an investment portfolio, you claim the interest back on that loan. same as people borrow money to buy property, investment properties as well. They claim that interest as well. And another one is, which is really cool, you actually touched on in one of your previous podcasts, was debt recycling. So pulling money out of your house to invest, and that becomes a tax deduction for, you can claim the interest back on that, which is not many people know. They've got equity of 50-50, and they go, oh shit, I can pull money out and actually claim an interest back. So that works in their favour as well.
100%. So that's a really big one, which the Rich Dad Poor Dad's a very good book to learn the basics of that, and that is the difference between good debt and bad debt.
Yep.
Number 2 is getting advice from professionals in the field, and it sounds like if you would have had a Brad Abbott around you, you probably wouldn't have invested in the BMW.
Yeah, well, I wouldn't have taken advice from you back then. But no, this is important, and to leverage off you, for example, if I had to go buy property, or if I had some of my wealthy clients ask me, I wouldn't throw darts at a dartboard. I would definitely seek advice from someone like yourself. I know the general information about property, but I would never be able to go into the lengths you could. So for those people that are looking to buy property and when and where, I would really suggest engaging people like yourself to not only educate them, but do the legwork and make sure you're making the right decisions. Like I said, you won't always get it right, but if you know you've got someone else on your side working for you, you know you're really going to get
You
the best
hedge your
outcome.
bets.
Yeah, correct. You've got more chance of getting it right.
And it's exactly the same with investing in equities and shares and superannuation. People can do it themselves. You can set up a Consec account and read a few investment blogs and think, this is a great thing to do. But the reality is people don't know. You don't know how to read a balance sheet and a P&L and the minutes from a company meeting to understand whether that's a good company to invest into or not a good company.
Yeah, correct.
So the reality is, for the small amount of money that you pay for professional help, and it's about paying for professional help, but then they're also getting the right professionals. There's a lot of good and bad on the both sides of those.
Yep, correct.
Is also very important. And then obviously budgeting is number 3. So actually knowing where your money is going, and regardless of how much you earn, whether it's a relatively small amount of money because you're starting off, or whether you're earning a significant amount of money, there's a saying that it's not about how much you earn, it's about how much you keep.
Yep.
And you often see the most frugal people who probably don't earn a great deal from a salary or a business perspective often end up the wealthiest, because they've just got such good spending habits and such good saving habits that you don't need to earn a lot of money. If you live a humble life, you can often create a significant amount of wealth.
Yeah, I agree. People think, $5 every day for a coffee doesn't matter, but I believe the small things make a big picture. And people often go, oh no, I've covered. They usually just list off the big ones, but then they don't account for the smaller ones, which when they go, I've got no money, if they actually write it down, they go, okay, now I know where it is. I mean, so many people have got Netflix, Stan, KO, XYZ, and you think, Jesus, do you actually watch 5 TVs at once, or is it just cool to say you've got that? Like, that sort of stuff. So it's that budgeting, knowing where your money goes. No point in saying I earn 150 if you spend 160, because then you're in a bit of trouble there. So.
Exactly right. So earning 60 grand a year but saving 20 of that is better than earning 150 and spending 160 and having a $10,000 credit card bill at the end of the year.
Exactly.
So that is a very important one. And then the last slide, just if anyone's got any questions as well, which can probably be more personalised, be selfish with these questions. If you have something that's going to be relative to your situation, ask it in the questions box. The only question we have now is the sound working? So I hope that is working. That would have been very awkward. But mate, essentially, if people want to explore, what you do in your services, what does that look like, and how do you usually help, your clients?
Oh man, my 2 biggest things is people and relationships. So if they want to explore the services, just reach out. I mean, got a great marketing team, so I'm actually on social media these days for the business. So
yeah,
I'm not just
I've heard.
I'm not just the one phone call or Google me person now. So I always respond in 24 hours.
And you're often down the Junction Tavern on a Friday as well, aren't you?
Mate, no, that was young Brad these days. Brad's in Wickham now, so.
The Wickham Hotel.
He's moved up in the world.
And likewise with myself, you won't find me at the Junction Tavern, but. What we do is essentially, we get super clear on clients' goals with property, and we help them build out their overall portfolio plans before we start looking at the locations and the assets. And then our job is obviously to help the clients fulfill those portfolio plans and keep them accountable to all the things we just spoke about.
Can I ask you a question before I start following through?
Hit me up.
Who would be suitable to engage a buyer's agency? Would it be the first person buying a home, or someone who's got a few and looking to grow more, who would
Mate,
be
it's a
an
good
ideal-
question.
Yeah.
So we help clients at literally both ends of the spectrum. So we bought a property last week for $500,000, which was a 1-bedroom apartment in the Hill. You know, and that same week we bought a $3 million home in Coogee, right? So it's people that are at the starting point of their journey that have got a relatively small amount of money in relativity to that $3 million purchase. But the reality is everyone has to start somewhere. So whether we are buying someone's first investment property or owner-occupier home, because we do both, the service and the advice we give doesn't change as to people. Last year the most expensive purchase we did was $22.5 million. So those two ends of the spectrum are so worldly apart. But the reality is the person starting out is often has the ambitions to want to get to that level, and there's steps that you have to take to get there. And again, our fees are relative to the individual, and it's probably the same with yourself, right?
Yeah, I agree. Yep.
If you're managing a large sum of money, that takes more time, more expertise, more dedication, from an hour spent perspective, then naturally the fees are going to be reflective of that, and it's the same with us. If we're working with someone who's got a $500,000 budget, the fees are relative to that budget as opposed to someone who's got many millions of dollars.
Yeah, which makes perfect sense.
Mate, we're just on the fees thing. Someone, anonymous attendee, that's a good name, just said fees associated for a financial advisor. So, mate, I think let's answer that in two parts.
Yep.
What are the common fee schedules for financial advisors? Because there is a few different ways that they can charge, right?
Yeah, so predominantly it's paid for via super, which not many people know about, and when they know that, it's good. And when it's paid for via super fund claims 15% tax deduction, tax rebate. When they pay for it personally, they claim that as a tax deduction as well. So a lot of high income earners choose for it to be that way.
Sure.
Old school way of doing it is percentage based, which I don't believe in, which it's sort of shifted to a flat fee structure. So, which it can vary, as you just mentioned, on depending on the complexity and what goes into it. It can vary to how much you charge given the hourly rate, knowledge, experience, etc. But I actually got asked this before, and again, I don't know how to answer it because I also am more than happy to help people as well. So it depends on, I'm not going to charge someone.
So it sounds like what you're saying is, mate, if anyone wants some advice, just hit Brad up, and mate, if he's feeling generous, he won't even charge you. But it sounds like there's really two different fee methods. There's a fixed fee of which you'd agree up front. That might be a yearly fee or a monthly fee or whatever it is.
There's an upfront one to engage, implement, do the scope, show you how we're going to support you and make sure there is value for your money. And then it's not just a once-off, we're a relationship business, so we'll support you through the journey as we go back to that time frame conversation. If we set something in place for 3 years, we're not just going to throw you out to the woods and hope for the best. We'll support you along the journey as well.
You don't do that to your clients?
No. Not the ones I like, I guess. Yeah, so there's upfront and ongoing fee.
And then, or another method, which obviously is not the method that you use, but some people do use, is a percentage of the overall assets under management.
Correct, yeah.
Sure. And you can do that in more tax-effective ways, like you said, sometimes paying for it through your superannuation, and sometimes paying for it through your personal income. How to find the best area around New South Wales or Australia for an investment property. There we go.
I think you can answer this one.
Mate, I reckon you were just thinking straight away like JB Hi-Fi. So it's a very, very good question, and there's a few variables to that question, because if your budget was $1.5 to $2 million, the area and the asset that we'd buy is probably slightly different to someone who we were just talking about is spending $500,000 just getting started. But I guess the fundamentals you can use to work out whether an area is worthwhile to invest in or whether it is not is looking at that location on the macro and looking at the last 20 years worth of data and seeing that it's been a consistent performer. So we're sitting in Newcastle right now, and very quick Google search of going 10-year capital growth rate of the Newcastle market or 20-year capital growth rate of the Newcastle market will show you what it has done.
Yep.
And if that number is sitting at 7% plus, that means it's an area that has doubled every 10 years, which is not a bad outcome. So looking at the proven track record of performance and then understanding inside of that location the kind of asset that you should be buying. And a really quick way to do this is to go to realestate.com, go to the sold section, go to whatever region you're looking in, and seeing what the most popular property types are in that location. And you've only got to do 3 or 4 scrolls, and you'll see that 80% of the properties are probably very similar. They're either houses or they're apartments, and they're 3-bed, 2-bath, 1 car, or whatever it is. And that then gives you a good scope on what the most common property is in that location. And if that all sounds too hard for you, you should give me a call.
Is there any trends people should look for? Should, like, if they, I don't know, seen a new mine was opening in WA, should they start Googling that area and do that approach what you said? Or?
Probably not, no. So I'm not a big believer, and this probably goes down to the timing the market as opposed to timing the market. So I think the safest way to build wealth is to back an area that has been a strong performer for the last X amount of years. And the longer it's been a performer for, the better in my eyes. That doesn't necessarily roll over into the business and equities world, right? A business that had done well over the last 30 or 40 years may actually be out of business tomorrow because things change.
Yep.
But with property, it doesn't. Usually the properties that have performed well over the last 30 years actually perform better for the next 30 because we have a stronger population, we have higher incomes, we have more scarcity to land, and naturally that then puts upward pressure on prices. So I'd much rather back the constant performer than trying to back the new hotspot, where you may actually make more money in the short term in that hotspot, but it's much more of a gamble. Please, would you discuss the first home buyer grant and how you can avoid not having to wait 6 months to get a renter in the property? Sam, it's a good question, and it's probably one that I can answer offline.
I was going to say there's a bit of research to that.
No, but the rules as such with the first home buyer, rules in quotation marks, to the first home buyer incentives is that if you buy the property, it has to be for owner-occupier purchases, and you are meant to live in the property or classify it as your owner-occupier purchase for, it's usually the first 12 months. So there is, creative ways that you can get around that. You could potentially live in the property and rent out bedrooms. You're still living in the property, but you have to be creative. It depends on how open you are to bending the rules. That's not something I can advise on though. Criteria that makes a property a good property for investment, rental yield or capital growth, apartment or house for the land value. Great question. There we go. We've gone from what's the best location, and then how do I look the best property in that location? So the criteria that makes a property a good property is different in every single location. So what I would buy in Brisbane is very different to what I would buy in Newcastle, which is very different to what I would buy in Sydney or different pockets of Sydney. And it all comes down to what the owner-occupier demographic inside of that location actually wants to live in, because the owner-occupier buyer makes up 70% of the buyers in the marketplace Australia-wide. So that's why you want to buy a property that appeals to those people. They want to live in different things in different locations. So again, you need to understand the intricacies of that location and what people value. And for example, where I grew up, what was of value was the larger the block of land, the better. If you lived on acreage, that was very valuable. Whereas where I live now, which is in the city of Sydney, it's really got very little to do with the size of the land. Sure, that has an impact, but people pay for convenience. People want to be in, a walking distance to cafes. They want views, etc. So the criteria for each of those locations is different. I'm a big believer in always chasing growth over yield, because the incredible thing about property is leverage and being able to use a significant amount of someone else's money, which is usually the banks, to grow that money. And that happens through capital growth, not necessarily rental yield. And again, apartment or house, different in every locations. I have both houses and apartments in my portfolio, and if I look at the performance of each, they're probably very, very similar.
What about commercial over residential in response to that question?
So I think we look at portfolios over 3 phases. It's the incubator, 4 phases actually. Like the incubator, for people who don't necessarily have a huge amount of capital to work with right now, they start in lower dollar value assets and they try and manufacture some growth, and that's usually through some renovating, and then we transition that money into foundational properties, which are usually higher quality, higher purchase price assets, which you ideally never sell. Yep. And they're just consistent performers. Then we've got assets which are more accelerator, which is developing or doing some major renovations, and we treat that more as a business because you're putting in capital and then pulling a return in the short term. And then there's legacy assets, which are usually assets when you get to the later years in your life and you're wanting to generate more cash flow. You start looking at those assets, and the legacy assets are more commercial assets because commercial is usually a much stronger cash flow performer. Yep. The yields you receive are net yields, which means your tenants usually pay all of the outgoings. So the money that you receive in your pocket, usually the only expense you have is the capital expenditure for that property. So keeping it up to scratch, and then the interest payments that you have if you carry debt. But commercial assets are great, especially if you're in the right sector of commercial, so industrial or light industrial. Over the last 5-ish years has been incredible because of the transition of Australian or global businesses going from bricks and mortar to e-commerce, which means you need places to store all of your goods. We always look at commercial assets ideally with the same scope that we look at residential, which is location, owner-occupier appeal, and the scarcity element. And scarcity in commercial is usually things like multi-tenancy. So you've got one commercial asset with a few tenants in there.
I was going to say that whole shared office space would really support that too.
Exactly, yeah. And 2,000 square metres of office space in Sydney CBD now probably isn't as valuable as it was 10 or 15 years ago, and the vacancy rates now are probably sitting at 15%. And that's because not many people, or not as many people I should say, need office space. Here we go. What would your advice be to someone who is willing to sacrifice life in a work-life balance? What would your advice be to someone who is willing to sacrifice life?
So just
get a second job or second income or increasing borrowing power or speeding up essentially investing. Mate, what are your thoughts on that?
I can get a second job, only because when you're so ingrained in doing what you do, working in another job that's different to what you currently do gives a different perspective on life.
Very true.
Meet different people, different walks of life, learn new skills, and whether it be long-term, short-term is irrelevant. I find I've done it, so that's why I say it, but it gives you relatability to different people in different situations, have different conversations. If I just spoke to people who spoke about finance and money, man, that would be boring. So I've worked in pubs, I've wanted to work on racetracks, I've done all that sort of interesting stuff to learn about that. So when I go out and I can talk to different people, you never know where a conversation or a relationship will take you.
I'm the same. The more income you can earn, the more that you can invest, and naturally the shorter that's actually going to make your working life. So if you can earn double the amount of money, you can essentially work for half the amount of time if you invest that same amount of money.
Yep.
And the best way to increase your borrowing power is to increase your income or decrease your debt. So the best way to decrease your debt is to earn more money. So it all starts with income, and the easiest way and the fastest way to generate more income is usually through working. What are your average returns over the half or full decade for both of you guys? Fuck.
Yeah, how long's a piece of string?
Yeah, it depends on how you look at that as well. So like when I look at returns, I look at return on equity as opposed to return on a property going from $1 million to $1.1 million, because all I really care about is what hard cash I've put into a deal. So if you look at how much money I physically put into my investment portfolio and the capital that I've generated off the back of it, it would be in the thousands of percents, not 10 or 20%.
Yep.
But it's been a 10-year cycle now. We've had a really strong property market over the last 10 years as well. But I think that's a really crucial thing to look at, is what is your cash on cash returns or your return on equity, as opposed to your return on the overarching portfolio, which is usually made up of a lot of debt.
My approach was I sort of set those time frames and not got greedy. I knew I wanted to achieve, and then I took it off the table, and then I went and bought the next thing to keep going. So to put that into a dollar figure, I actually honestly couldn't tell you, because I know I came from humble beginnings to work my ass off to build that up, to then go buy X, and then to sell that, and then to buy Y. That's sort of what I've mainly focused on. So sorry I can't answer your question directly, but two different approaches, I guess, from two different people.
That's right. Best advice or apps to assist with discipline of budgeting? I'm probably not the best person to talk about budgeting.
Yeah, I'd say different bank accounts is a good one. Ones that don't allow 24, like instant transfer, which is getting harder to find, but that's probably been a good one. And then, it sounds a bit ironic, but spend it before you buy it, as in spend it on the main thing, so you don't sit there and think you can believe yourself, because you'll end up talking yourself into spending it. So
hypothetically speaking, let's just say someone got paid $1,000 for the week.
Yep.
And 300 of that goes to their rent, 200 of that goes to their groceries and electricity and all the other stuff that they pay out of that, and they've then got $500 worth of discretionary spending.
Yep.
Would you then have an automatic transfer go straight from when you get paid into your investment account of, say, $300, which essentially means you've got $200 discretionary spending?
Yeah, spot on. So like, for example, say your main one's Commonwealth Bank, and then you set up a different one, Bankwest, because I know they're 24 hours for the money to actually appear there. I'll just put it in there. And that way you've got, what you've got to play with, and you know that if you want that, doesn't matter how hard you try, it's either A, in the ether, because it hasn't appeared in the bank account yet, whether it go to or from. That's, I found, the best discipline way.
That's right. Or just spend it all, and then you've got nothing to spend.
But also investment accounts, I don't want to touch on that too much, but like an investment account helps because you can't just immediately sell the money and get to it because they've got security measures in place. Now it takes 24 hours because its main purpose is to invest it. So.
And to be honest, that's one of the things I love about property, because I'm not a very good budgeter. The more I earn, generally the more I spend. But the great thing about property is it's like a forced savings account, right? So, you've got X amount of mortgage repayments per week, depending on the level that you're at, and that even though it might be going into interest or it might be going into principal and interest, that's money you have to pay. You don't have a choice.
Exactly.
So regardless of whether you want to spend it or not, it has to go there, and then you work out how you're going to live on the remainder of your money.
And your asset isn't necessarily liquid. You can't just go take 3 bricks out of the house and go spend it. Yours is solid. So
exactly right. I'm an expat. Do you guys have an experience of working with clients that are long-term expats? Yeah, we buy a lot of property for expats naturally because they can't be here in the country and they don't really understand the marketplaces in which they're investing in. And we're about to buy for a lady this weekend actually, who's living in Dubai. She's Russian and she just got the correct visa to be able to purchase in Australia. And she's worked out that buying in Australia and paying the premium of stamp duty you have to pay for not necessarily being an Australian citizen, she's going to get greater returns over a long period of time than investing in other asset classes.
Yeah, and I do too with people, depending how long they're going away or how long they're here for and what countries they're from, the tax consequences and can they bring money or can they take money and what to do and what, again, when they're liquidating the assets or like superannuation, for example, can they take it with you and can they bring it over? That's, got a bit of experience with them. It's not as off the cuff, it's a bit more complex work, but yeah.
Mate, what have we got here? It's good to see the questions coming through. Buy the biggest land for your dollars or just buy below the median of that area? I would much rather buy a smaller parcel of land in a better micro location of that suburb or region than buying a larger parcel of land in an inferior pocket of the suburb, because it's land value over land content. Thoughts on blue collar investing, cash flow positive to lead into deals? Look, I'm just not a huge believer, and I think obviously everyone has to start somewhere, but when you really look at it, let's hypothetically say a property is putting $100 a week into your pocket pre-tax. By the time you pay tax on that, it's $2,500. You're likely to pay in tax, and then that's not life-changing money. Whereas if you invest it into a property that maybe neutrally or slightly negatively geared, but is growing by a significant amount, you will really notice that money when you actually need it, and the time is right.
I think clarity too around that. Is your purpose to see the property grow, or is it to pay you that passive income? I feel like that's getting a bit mixed between that too.
100%. Mate, why am I so bullish on rent vesting? Can you do a quick breakdown summary? So the theory behind rent vesting is you essentially can live in a rental property, which is usually 3 times the price of what you could afford to buy. And this usually works better when you're living in more expensive properties as well. So hypothetically speaking, let's say you had $3 million worth of serviceability to go and buy your owner-occupier home. So instead of buying that owner-occupier home, which on a mortgage, just interest only, would cost you $150,000 a year in repayments,
yep.
I would split that into 3 $1 million investments, of which would probably be renting for 40 grand a year each. So you've got three investment properties now paying you 120 grand a year, or potentially more depending on the yields. I'd then use that $120,000 a year. So you've still got the same you've still got the $3 million of money invested. I then use that $120,000 a year to then go rent that $3 million property, which you could probably rent for 1.5% of its property value.
Which you actually did a good video on that recently on your socials as well. Similar concept too, didn't you? So go check that one out as well.
For the property that I live in, for example, it's probably like a $3.5–4 million apartment in Darling Point, and I rent it for $1,250 a week. So to own that property would cost me a minimum $200,000 a year just in interest. Then you've got body corporate and all the other stuff.
Sure, I don't know that stuff.
So I live in it for $80,000 a year, which is a third of what it costs to to own, and then you go and invest that money elsewhere and get greater returns. And the debt is also then tax deductible. Tom Lewis, where can those of us that couldn't attend the whole webinar view the recording? We'll send it across. The beautiful marketing girls which are sitting behind us will send the link out. Any budget platforms or templates that you can specifically use? You got any, mate?
No, all I'd say is actually write it out, because until you're confronted with it, you don't realise how bad it is until you're actually confronted with it. So write it out on a bit of paper, write out every little bit, and that's just a picture, and that you can change that. It will just highlight the places where you're spending and what can change, and it'll be an awakening, or you might just want to get that second job as someone asked before.
Look at that big message someone said. That's very kind, isn't it? Thank you so much for all the info you put out. Someone just purchased their first property. I knew nothing about real estate prior to Feb 2022, and by watching your Facebook videos by September 22, I had my pre-approvals and found my broker, and now I'm 4 weeks away from moving into my first home. See, that's someone who took action. Well done. Congratulations on that. Last question. What's the last one here? In your opinion, overall Melbourne, Sydney, Queensland, ACT or Adelaide, what's going to have better growth for the next 10 years?
Just all of Australia, pick one.
I'd invest in Sydney personally. In Sydney. If I had no budget constraints and...
Why?
Mate, it's the global city of Australia, right? Melbourne's population will take over, but it will never be Sydney. So...
Apartment or property?
If I had no budget constraints, I would buy a house.
Yep.
Yeah. Right now, I think where I'm seeing the most value in Sydney is the inner west, because you can buy a Torrens-style property on 200 to 250 square metres of land, less than 10 k's from Sydney CBD for $1.5 million, which is, if you then compare it on the other side of the city, on the eastern side of the city, that same 250 square metres of land is worth $4 million. So I see a huge amount of value there. And then on the other side of the bridge, it's worth, the same amount.
How close do you reckon we'll get to that same price range?
I think the inner west, which is that pocket of Sydney, will see a huge amount of growth over the next 5, 10, 15, 20 years. I mean, it's been a consistent performer already, but I think the disparity between the two locations will start to shorten, because we're seeing people come from the more affluent pockets of Sydney to the inner west because it's way more affordable and you get more value for money.
Which is just that ripple effect, right?
Exactly right, mate. That's called gentrification. All right, folks. We hope that helped. I need to fill my cup of water up because my throat's getting sore. If there's any questions that follow on from this, my email is jack@henderson.com.au. Your email is
bradley@theadvisorcollective.com.au.
And then for anyone who missed this, we'll send out the recording over the next couple of days. Awesome. Thank you.